So we're at this jumping off point now that really to me seems truly unprecedented. And I think if I had to sum up my my economic outlook, I think the economy is on the cusp of grinding to a halt. I think just in general, we have a broad, pretty wide overvalued market full of crap. And we are so overdue for a real deleveraging that this market needs to shed its skin so badly. Every third company is like a total fraud or not generating cash or just a story stock. So I think everything's in a bubble, to be honest with you.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Chris Irons is the author and publisher of Quoth The Raven's Fringe Finance, which has risen over the years to become one of the most popular financial newsletters around, currently sitting at number 25 in the list of top financial Substacks worldwide. His take, as you'll see for yourself in just a moment, is unconventional and unapologetic, and it often succeeds in putting its finger right on the heart of issues. Chris has a talent for declaratively stating in simple words exactly what the rest of us are all thinking, but perhaps haven't succinctly voiced yet. So, what's his view of the economy and markets right now? Well, let's ask the man himself. Advance warning though, folks, Chris's colorful presentation style uses a fair amount of profanity. There are more than a few F-bombs in today's discussion, so proceed accordingly. Now, with that out of the way, Chris, thanks so much for joining us today.
Hey, happy to be here. Love your show.
Hey, Chris, thank you. Huge fan of your work. Really fun to finally have you here on the program. This is the first time we're meeting. As I mentioned in the intro here, you're a guy who's become very popular, even though your take is quite different from a lot of people in the macro space. I love how the range of topics that you cover, but that really that's the way in which you cover them. And I'd even try to describe it more, but I think folks will just get it through the course of this conversation. So probably the biggest favor I can do to folks is just to dive right in. I got a whole bunch of questions for you, a lot of it based on recent articles that you've written. But just to kind of help people get a sense for how you see the world, let me hit you with this one. What's your current assessment of the economy and the financial markets?
We're in a completely unprecedented situation, the likes of which I don't think there's any historical comparison. I mean, sure, people of my ilk in the Austrian school sound money, they'll bring up the fall of the Roman Empire and things like that. But really, it's with what we have going on today and the digitization of markets and some of the things that I think are aggressively kind of goosing the market into this stratospheric valuation territory. We've really never seen anything like it. So between the area where the Fed is right now, which is stuck between a rock and a hard place, and people will say, oh, well, the 70s, they've been here, inflation. We've never been here with the amount of debt that we've had, really on what feels like the cusp of you know, some big questions being asked about our sovereign debt picture and our currency.
Mhm.
Um, and the Fed feels like their hands are really tied. It feels like, right now, I'll sum it up. We've got a stock market at all-time high valuations. So if you look at the market on a combination of a number of valuation metrics, Bloomberg just put out a piece saying when you combine those, the market is at its all-time high in terms of its valuation. If you pick those things out individually, market cap to GDP, Case-Shiller PE, those types of things, we are either at or damn close to all-time high valuations.
Mhm.
That stock market at all-time high valuations is, in my opinion, right now being driven by a couple of things. It's here, A, because of the tremendous amount of liquidity that the Fed has injected into the system, most recently during COVID, but dating back, to 2008. We have a market that priced in gold has essentially been in a recession since then, that nobody really seems to notice because the nominal price of the market continues to move higher. Nowadays, you have seven stocks that are driving the market. We increasingly see that decliners are outpacing advancers in the Nasdaq and in the S&P 500, yet the indices still often trade green for the day. which
Hmm.
is a function of a way that a lot of these indexes are weighted, putting a lot of weight into names like, Nvidia, Tesla, Amazon, Microsoft. So you got a handful of companies that are driving the indices higher. The bid for those companies comes from a combination of an incessant kind of passive bid, which Mike Green is really the king of talking about, but other people have started to speak about recently, which is your forced buying from pensions, retirement plans, and ETFs, which have become kind of a tail that wags the market dog. The SPY ETF used to go up because its components would go higher. Now its components go higher because people are buying the ETF.
Yeah.
In addition to the passive bid, you have, in my opinion, options gamma driving, the flows in markets significantly. If you read like sharp websites like Zero Hedge, which you can say what you want about it, but I think Zero Hedge has some of the sharpest analysis in the financial world, top to bottom, that you're going to be able to access for free. The analysis is sophisticated enough to help you learn things that you don't understand, and it's deep enough to help you understand what's going on under the surface of the market. If you look at what people like Zero Hedge post about when they're posting analysis, a lot of times it's often talking about options flows. It's talking about put to call ratios. It's talking about, what CTIs are going to be, or CTAs are going to be forced to buy and sell at which levels. And options gamma helps drive a lot of these short term and ultimately what I think will be longer term momentum moves. So, in essence, you have a growing portion, a bigger slice of the market nowadays that doesn't buy and hold Microsoft, or go pick up a portfolio of blue chips and wait for its dividends and wait for it to appreciate. You have an entrance of an entire generation of, young, absolutely psychotic speculators, of which, I was one just like 10 or 15 years ago, but that have entered the market and the only thing that they know is the options market. So, the way that the gamification of markets, what they say, has changed things. You look at like how easy it is to buy options on the Robinhood app, what happened during the GameStop saga with the giant gamma squeeze in GameStop. And I think, and the growing sector of the growing slice of market participants that are not institutional, but they are, really unsophisticated novice investors. And if you go on something like Wall Street Bets on Reddit, you don't even see people posting photos of owning equity. Every single post, the wins and the losses are options. And so what happens is when people go out and they buy call options, the dealers that sell those contracts are forced to go in and buy the equity, buy the underlying. As a hedge against the contract that they just sold, which basically means they have to buy stock. They're being forced to buy a little bit of stock. And I think between the options flows, a psychological assurance in investors' minds that the market can't go down and the Fed will always bail them out, which I think is will become a giant black swan at some point. But everybody's psychology on the stock market has been so drastically altered by monetary policy over the last 20 years that people just believe nothing bad can ever happen. And so that psychological kind of framework that they're in, combined with the purchasing of call options, combined with the outsized buys of high valuation names from the passive bid, which hasn't slowed yet. And you have a lot of tails wagging the market dog. So you have the market going up, what for I think is what is for a lot of the wrong reasons. And instead of analysts coming on CNBC and saying things like I'm saying now, like your guests say, which is market cap to GDP is, it's two sigma deviation higher than it's ever been, or if we were to revert to the historical PE mean, we would drop 60%. These types of inconvenient, ideas. What happens is you get a bunch of assholes on the sell side who don't want to, piss in the punch bowl, who go on TV and backfit a bullshit narrative to fit what the market is doing instead of looking at what the market is doing and then analyzing that accordingly. And so between cowardly analysts, cowardly financial media, unsophisticated investors, and brand new market mechanics that forced buying where there has never been, in ways that there has never been before, hooked up to a fire hose of liquidity that hasn't stopped. You have what we have now, which is what I think to be a pornographically overvalued market in a basically batshit insane investor psychosis, which has persisted for the better part of a decade. And I think right now we are on the precipice of reality hitting in a way that I don't think people are ready for. And why do I say that? I say it because, real rates have been positive now for the better part of the last 2 or 3 years. You know, I pointed this out 2, 3 years ago. I was early. The market has made me look like a fool. That's fine. I can deal with it. My, subscribers know that every other piece is a mea culpa for me, and I'm okay with that. They know I'm learning, and I know they're learning. We give each other grace. It's beautiful. But where we're at now is we are 2 to 3 years into this positive real rate cycle, and the very last drops of liquidity remaining from COVID are starting to dry up. And the economy, this lag has, basically you have a huge debt bubble in 2021 or whenever they started raising rates, 2022. The positive real rates is like putting a fucking time bomb into the plumbing of the economy, but it has to kind of make its way through the economy, which is your lag between monetary policy and what the economy does, that delta, before you start to see the results. And then as the Fed cuts after that, once the time bomb makes its way through the plumbing of the economy, and you start to see things like the jobs report we just saw last Friday, these little signs, AAA rated CRE, being defaulted on, crazy private equity marks that no one is going to be able to find a realistic bid for when these people need to get liquid. All of these little black swans that are floating around in the market, that ice is starting to crack now. The jobs number shows that passive bid may eventually start to wind back, which is a problem in and of itself because a lot of these funds don't have the cash to redeem people, meaning when people go to redeem from these funds, they're going to be forced sellers of stocks instead of forced buyers of stocks. And at the same time, it's also showing cracks in the economy, which when that happens, you get deleveraging, you get a slowdown in discretionary spending, and that's when the E denominator in the PE starts to fall, and then you have a 40 PE market that all of a sudden looks like a 45 PE market just because earnings are dropping. All of those things are starting to happen now. While they're happening, inflation is running at about 3%. We have a president that's begging the Fed to lower interest rates, and the market will eventually force the Fed's hand to lower interest rates once we have some type of sharp deleveraging, which
Right.
I think will happen. And I think we were days away from in April seeing a real shit show, a big, major, not systemic, but much larger system wide margin call after Liberation Day. That will happen, and there will be something that the Fed and the president can't do to stop it. And then the Fed has the option of lowering rates and eventually, assuming the bond market cracks up, buying bonds or doing yield curve control. What is going to happen when the Fed does that with inflation already at 3%? Your guess is as good as mine. But there really doesn't seem to be a historical analog to point to that say we've been here before and this is what's going to happen. The only thing I know is there's going to be some type of mathematical and common sense blow off valve where something is going to go wild that hasn't gone before. I don't know if housing prices will crash and then they'll double. We're going to see some type of crazy distortions in the market as all of this plays out. And that's why, as my readers know, I'm love to own gold. I love to own sound assets. I love to own, things that can't be printed. That's why I'm in emerging markets as opposed to U.S. equities. I prefer a lot of world markets to U.S. markets now. But mainly, my trade is being diversified both in and out of the dollar and mostly in, gold miners, silver miners, a little bit of Bitcoin, a little bit of real estate. Because, and you don't know where it's going to go. You don't even know what to root for. Like, do you root for a deflationary depression where, we have something worse than the Great Depression that happens and the market corrects and, the free market people will tell you, okay, like that has to happen. The tide has to come out. Or do you root for the sharp deleveraging followed by hyperinflation scenario, which puts a nice pastel, uh, shine on everything in nominal terms? The stock market goes higher, but like at what cost? People are being brutalized in the dark machinery of night by the inflation genie, which will then be running at, whatever, 5%, which is really 15%, or, 7%, which is really 17%. So we're at this jumping off point now that really, to me, seems truly unprecedented. And I think if I had to sum up my my economic outlook, I think the economy is on the cusp of grinding to a halt. You see it in credit card delinquencies, you see it in auto loan delinquencies, you see it in the amount of margin debt out there. All of those trends are going to continue. You see housing prices starting to blow off a little bit. The way that deleveraging works is, discretionary spending goes first, then people don't pay their credit card bills, and they don't pay the auto note, and then they don't eventually pay the mortgage. So it kind of goes in that order. First, they sell off the risk assets, to raise cash. Then they start defaulting on the littlest things all the way up to the house. We're already, in the second or third tier of that house somewhere. It's just nobody really notices it, and nobody's doing anything about it. That will accelerate as the deleveraging continues. So the economy, to me, you know, is approaching that mathematical certainty that I thought positive real rates were going to take us to 3 years ago. We're just only now reaching it. As far as the stock market, you know, uh, you look at the distortion of the market during COVID. I mean, what happened? The market went down 40%, and then the Nasdaq tripled in like 3 years. The Nasdaq's an index, okay? An index tripled in like the 3 years after that. Not fucking normal. You know what I mean? Like, this is not 1985 buying shares of the top 10 best dividend payers and just sitting on them. Like, this is a totally different stock market. So, as far as what's going to happen and what the best case scenario is, I couldn't even tell you. That's why I like owning gold. I can kind of sit back and bear witness to this unprecedented experiment in monetary policy history and human history play out, and do what I do on my blog, which is run my mouth and talk shit, and be thankful that I have people there to listen to it who I feel like I should be billing. They should be billing me by the hour instead of me billing them by the month.
Wow. All right. Well, look, interview's over. You answered
Mhm.
basically every question I was going to ask you there. So
Thank you for
it's
having me
been
on.
great, Chris. Yeah. No, all right, Chris. So phenomenal kickoff to this. And honestly, you touched on so many issues that I'm hoping to talk to you about. We're not going to have time, obviously, in this hour to get through all of them, but I'll do my best. And I think folks are getting a good sense for A, how you see the world, B, how your mind works, and C, you're really validating my description of you as a guy who can just succinctly and colorfully put his finger on the heart of a matter. Okay, so you talked about the high level of overvaluation in the stock market. I think you called it pornographically overvalued, which I think is such a great description. Um, and we to a certain extent we've got this unstoppable force versus a movable object collision coming ahead, right? Where you say we've got this market that's been driven by all the things you talked about, the passive capital flows, whatever. It hasn't mattered, right? It's just to make money, just be long and hold strong, right? Now you're saying, look, we're combining that and the whole crazy investor psychology that's wrapped around that. That is hurtling towards the reality of an economy that is slowing,
Right.
and we're starting to see increasing cracks in here. And basically, one of those two things is going to have to matter more than the other, right? And I get the sense
Right.
from you think the economy is going to win out for understandable reasons. There's going to be some big reckoning here, some probably massive, surprising, and probably violent repricing. Change any of my words if you disagree. That's then going to require, some sort of reaction on the central planners. I think
Right.
you think that's probably going to be pretty extreme. You mentioned, the Fed stepping back in to buy some more QE, maybe it takes a form of yield curve control, whatever. I believe that's probably a big reason why you own gold and the precious metals and stuff that you think that'll benefit from current trends anyways. But if we get to that kind of big rescue, then yeah, that's going to send the prices of that
It
stuff
has to
presumably to the
happen.
moon.
It's a foregone conclusion. What else are they going to do? What are they going to do? They're going to let the bond market crack up?
Right, right. I mean,
They're going to let yields go to 10%? Like, no way. Because as soon as they start to slip, we saw that's like emerging market shit, right? We saw stocks and bonds both selling off at the same time in April. And so what are they going to do when that happens again? And I felt there was one night watching the 10-year where I was like, this is it. Like
this is it. It's going down.
I stayed up, I was laying in bed. I stayed up till like two o'clock in the morning, just watching the 10-year yield, which I never do that anymore. I don't just sit in front of the computer and just watch whatever. And I was texting with I don't know, some woman at the Wall Street Journal, some reporter, I forget her name, but I was DMing her on Twitter, or she DM'd me and I DM'd her back, or I sent her a message about a tweet that she put up, and we were talking about it, and I was like, this really feels like it's it. And I think I said the same to the guy Dami too. I was like, this feels like it's gonna break. Like, it was such a weird thing to witness the 10-year yield just kind of almost losing it, like almost
Run away. Yeah.
spiraling right, run away, exactly. And so that'll happen again. And when that psychology starts to, I don't know what Besant did other than, maybe he said to Trump, look, we got to put a pause on this because shit's about to get real. But there will be a point where the bond market really does crack up. And because everybody's thinking like this now, it's not like this was like the 2% case of this happening years ago. Now it's like 15% of the people out there are thinking about it. Like, people that are sharp, that understand monetary policy, like, it's no longer the elephant in the room. Like, it is the elephant in the room. Like, everybody can see it, like and so it's talked about on podcasts like yours. It's talked about, you got guys like Gunlock talking about it. It's even seeping into the, cowardly financial media a little bit, bits and pieces. And I think Scott Bessent understands it too. And so, what are we going to do? Like, it's like inflation, like psychologically, once you lose it, it's gone. And so then it becomes a self-fulfilling prophecy. The first time that, the first time we move up whatever 30 basis points in a day, or whatever the threshold is to be considered an extreme move that gets a lot of news coverage about, holy shit, look at the US bond market. The first time that happens, then it becomes a snowball rolling down a hill. And
Yeah.
there's nothing left other than for eventually that to get to a point where the Fed steps in and starts buying bonds.
Okay. And so, presumably, look, right now, market don't care. So even though maybe 15% of the people are paying attention, the remaining 85 are they're all in, right? They're buying their call options every day, as you said earlier. In many ways, maybe the retail, this massive retail buying we're seeing right now is the patsy joining the poker table at the end of the game, right? So if things break in the way you think they could, we get a big downdraft in prices that again catches everybody by surprise. It changes that psychology that you're talking about, right? And to try to get that psychology repaired and get people back into, get you out of freak out mode. Yes, the central planners are going to have to step in, but presumably, given the size of what you see coming, they're going to have to step in with an awful lot of firepower, a lot of unnatural acts to try to reverse all of that. And looking by your face, I
It's
think you
That's
agree.
it's a gross understatement, right? Because that's what they did during COVID. Is that the only difference now is that more people, more of the populace understand how that, like, the last time they did this, how many internet memes did you see about, Jerome Powell and the money flying off the printer,
Right.
like, and that clip of Neil Kashkari going, the Fed has infinite cash, the Fed has infinite cash. Like, so people started ridiculing them 5 years ago, which is essentially a loss of confidence, is what it's going to develop into. The next time it happens, the QE will be that much larger. It will be, what Larry Lepard calls the big print.
Right.
Except now we have more of the nation empowered to understand exactly what's going on than we ever have. And this was a factor of both inflation being a political football during the last election, but also, things like Bitcoin, which, whether you love it or you hate it, in order to talk about it, you need to have a rudimentary understanding of monetary policy to begin with. And
Right.
so, again, to go back to this generation of young, psychotic, tattooed freaks of nature that are like in the stock market, so many more of the 20-year-olds in the country know what the Federal Reserve is and how it works now more so than ever. And of course, as soon as you learn how it works, your immediate common sense conclusion is it's a Ponzi scheme, right? Like that's what mine was. I was like, how can this be? Like it's the polar opposite of all of the laws of economics and finance I've learned my entire life that apply to me personally, corporations, anything. So like it's got to be your first thought that like this is insane. There's no way this could go on forever. So assuming half of the people think that, and we have a whole new chunk of people now that understand monetary policy that never did before, the environment for the next print is going to be, peak humiliation and probably potential confidence loss in the Fed. And now there's all these exit ramps, a la Bitcoin, gold, whatever you want to say.
Right. And in the Fed
That
and by
that
connection, the US dollar, right? The purchasing power
right,
of our fiat currency. Yeah.
right, and so now like the regular mom and pop people, like my dad, who was like a mailman for 40 years, like he didn't have time to sit down and figure out like why inflation happens. He knew what he earned. He, knew what things cost. And he said, okay, we have to spend less than I earn in order to save. And that was enough to provide us with a great life. But like, he's not gonna get done working 6 12-hour days at the post office, come home, cook dinner, sit down at the dinner table and be like, hey, what do you guys think about this fucking monetary policy? Like, do you guys think Alan Greenspan's lying? Like, I mean, it's like, but now there's a whole, most people that didn't before, the people that were too busy out there actually generating products or services or doing things to move the economy and the country forward, those people now understand it in a way that they didn't before. So it truly is going to be like the stage is set, right? Everybody's like, hey, here's what we all think the Fed's going to do. We'll get our sharp deleveraging somewhere. CRE will set it off. Auto loans will set it off. Who knows? Something will set it off. Some guy eating a donut wrong in Belgium, affects the price of an ETF somewhere that kicks off, a 10,000 domino transaction that results in the NASDAQ opening limit down. Like there's a million things that could happen, but that will happen. And then the stage will be set. And everybody's going to be like, all right, motherfuckers, time to dance, Fed. Let's see what all these tools are that you keep talking about, which of course everybody knows there's just one tool. There's just print unlimited money, and that's it. There's nothing signed. The fact that they're building a $2.5 billion building, unless most of that is, some type of new technologically futuristic safe to store gold, which if it is, I understand.
Right. If
Other
they're
than
building
that,
that in gold bricks, okay, but otherwise, yeah.
what do you need all this stuff for? You got a lady who, is one of 12 people that controls the price of the world reserve currency, where every quarter basis point move in interest rates sets off a quadrillion-dollar aftershock through the global economy, who can't fucking not commit fraud on her mortgage application. Like, this is the best and the brightest of like what we have. So forget about the fact that like these people are setting the price of money, which they shouldn't be doing to begin with. But like, I don't think anybody really has any idea what they're doing. You listen to Powell, and I like Powell. Actually, I do think he's like, he's got a little bit of a backbone. I like him a lot better than I like Yellen. But he gets asked at these conferences, like, what's the neutral rate? And the answer is, well, we got 12 bad governors. Everybody's got an opinion, and I don't really know. And it's
Yeah.
like, great. Like,
We'll know it when we see it. Yeah.
right. Yeah, it's more of a feel, like, and all this talk about a 2% inflation target. And now they're saying, okay, well, employment could just cause us to throw that out the window. Hey, by the way, we have to choose now between, stable prices and maximum employment. Now we can only choose one. So now we got to work the gas and the brake at the same time. It's just distortion after distortion after distortion. If the economy was a house in like the year 1970, before we went off the gold standard, every little tweak that we've done, whether it's taking the dollar off the gold standard. I listened to that speech the other day too. That was Nixon, right? Whoever it was
Nixon.
said,
Yep.
yeah, said we're doing this to to protect the strength of the dollar. I'm like,
Right. And sorry to
like,
interject, but we're doing this temporarily, he said.
yeah, exactly. Well, there's nothing more permanent than a temporary government program.
Yep.
But he said, like, we are doing this to, protect the strength of the dollar in like the second sentence. And you're just like fuck off. So, anyways, if the economy and markets were a house, then every little tweak that we've made has been like a different addition on this house. And here we are in the year 2025, and our little house has become this like mile-long monstrosity that is just like so top heavy. There's so much shit and so many distortions in the market now that the next one is going to be that little Jenga piece that just topples the whole thing. And that's why now you have people talking about, hey, where are all these giant gold deliveries going from, from the futures market? Or like, what would a debt jubilee look like? Like, so we're right there. It feels like we're knocking right on the door. We are at the edge. But keep in mind, I've been saying similar things for the better part of a decade because it hasn't made sense to me since I learned how the system worked. So they've been able to perpetuate it for, since I started talking about it, enough to make me look like a fool, which I appreciate. But so maybe they can continue it going forward. But right now, it really doesn't seem like there's a way to do it without blowing something out, whether it's the price of gold going to 7,500 or it's a collapse in another market, or the government having to take whatever the auto market and subsidize it. There'll be some bullshit. It's like what they did with the regional banks, and that, by the way, that was just a symptom of what's going on, because you got banks and regional banks specifically that not only have tons of exposure in treasuries because they had the genius idea of putting their money into treasuries while they were yielding 0% or 50 basis points. Bonds are lower since then, so they haven't taken marks on those bonds because they don't need to, because they're treasury bonds. But that doesn't change the reality of the fact that like the bonds aren't worth the same. And these are the same banks that, if there's a bunch of them. I'm not going to go through the names, but what I'll say is there's a plenty of lists online of regional banks with massive commercial real estate exposure, and I would encourage everybody to look at it and see if your local regional bank is on that list. My parents' bank was on that list. I told them, move your money from there. This is like a year ago when I was looking at this, because commercial real estate is an area where you have a ton of subprime crap that hasn't been marked properly, that you have AAA rated stuff in the commercial real estate space that's being defaulted on. I mean, that is essentially what happened in the housing market during the Big Short, right? You had the AAA bonds and the high credit worthy stuff. It wasn't just the B and C rated crap that wound up being defaulted on. So this, the commercial real estate is not as big as the US housing market, but it's still a sizable portion of a market. And what happened is that started to slip when Silicon Valley Bank disclosed on that Friday that they needed to fire sale equity to raise $1 billion or whatever it was. By that Monday, they had $50 billion in like redemption requests or something ridiculous. And that's how quickly things can change. It's like COVID. One night, I was the world's biggest fear monger and nobody wanted to listen to me about how serious it could get. The next day we woke up and people were fist fighting over toilet paper at Costco. So things can change very quickly. And, commercial real estate is kind of teetering on the brink. And we saw that with, the Fed basically have to bail them out with the bank term funding program back in March a couple of years ago. So that's one of many little spots in the market that I think could slip. And I think we are on thinner ice than people know. And I think that we have more market participants now that are in the mindset that nothing can go wrong than ever. And I think the rest of the market participants have been coddled so much by monetary policy and by the dickless, cowardly media, financial media specifically, and their inability to ask pointed, critical questions about individual companies and the macroeconomy and the Fed. They've been coddled so much that I wrote an article called "The Next Market Crash Will Break Our Fragile Brains," because
Mm.
that's what I really think is going to happen. I think we're going to see. I put out a post
We're going
when
to get pushed out of our financial safe space that we've lived in.
yes, I put out a post as I was watching the numbers in China go up in December 2019, and doing the very easy look. If I can do it, anybody can do it. The very easy deductive reasoning that like, or logic problem of like, hey, we got a million people flying back and forth between these two countries. This thing's already here. We just don't know about it yet. And I wrote in December or January, before the Olympics were canceled, before the basketball season was shut down, before we even had a case count in the US, before anybody was paying attention to it. I wrote, it's time to start doing some mental gymnastics, because the psychological effects of this coming here and us not having our heads wrapped around it, at least until our allies in South Korea and Italy were able to make sense of things, um, it's really going to put a lot of mental stress on people. And I put that out on Twitter, and the response that I got was out of control, with people just telling me like, calling me a fear monger. I had one guy found my phone number and called me, and said, my girlfriend's a nurse at so and so hospital in New York. Like, you're not helping. Like, you're setting off a chain reaction of panic, and I'm just like, all right. Like, the response I got was like that. But then, looking back now, you see what the psychological scarring of COVID has done. And you saw what it was like when we were in the midst of it. You had people that won't shake hands. You have police beating people in the park in Australia for taking a walk. You have the, Coast Guard arresting a guy on a paddleboard out in the middle of the ocean, surrounded by 10 miles of nothing, for not wearing a mask. So this, I think, is going to be a similar type of situation where I don't think people understand how bad it could get. And even if it doesn't get bad, even if we see a 20% drawdown or a 30% drawdown, and then we just stay there for 10 years, like Japan, like that will be a different kind of like brutal psychological death march for people that I don't think anybody is ready for, or most people aren't. So I don't know. I try not to be a pessimist. I try to objectively examine what the facts are and make my decisions accordingly, and not just gravitate towards the worst case scenario. But I don't know how anybody could look at the fiscal picture and the monetary picture and the economy in our country and the stock market and say, hey, this is a great time to buy stocks. Everything's fine. Like, I don't know.
All right. So
Maybe it's because I didn't go to fucking Yale. You know what I mean? Like, maybe it's because I don't have a PhD. Maybe that's the problem. Maybe it's just because I'm using stupid like math 101, like where 1 + 1 = 2, and that doesn't make you a racist, for saying that. Like, I don't know.
well, no, it's one of the things I appreciate about you. So I did go to some of the, bigger brand schools for undergrad and for my MBA, and I have found in my journey, Chris, that way more often than not, reality, if you can explain it, in a single sentence using, fifth grade words, then you're usually pretty much a lot closer to where reality is. Where when you get too caught up in the wonkiness and the formulations and all the justifications of why it's different this time or why we're smarter this time, that's
Yeah.
usually, where we fall into big trouble. So look,
Next time you find somebody that, and look, I own Bitcoin, right? But like next time you bump into somebody that owns, whatever, Ethereum, be like, listen, Ethereum's $4,500. What are you paying for? Just, something like that. Explain to me simply what you're paying for. Like, you're paying $4,500 for what? And just listen to somebody try to give you an answer on that. So this goes back to the Peter Lynch. If you can't illustrate it to a fifth grader with a crayon, right? What did he say?
right,
Like an investment idea to a fifth grader
pretty
with a
much, yeah.
crayon? Yeah, then it's like, if you don't understand it, you shouldn't be invested in it. That's it. That's a great rule. That's one that like I don't even have to give a disclaimer on almost all my stuff. I say, hey, I'm not a professional advisor. I don't give investment advice. No Series 63, no Series 7, no FINRA registration, no SEC registration. Not just a guy trying to figure shit out. That one, I don't even need to give a disclaimer for. If you don't understand it, don't invest in it. That goes for your local banker handing you a sheet this thick about fucking annuities or some wealth product that they want to put you in, some bullshit where they're going to take a fee. It goes for fart coin. It goes for fucking, binary options on the price of donuts in Belgium. If you don't understand it, don't invest in it. That's a great rule. Just sit there, and you're better off just putting your money on the table and looking at it and losing 3% a year, because even then you'll probably have 10 or 15 years of runway before the government inflates away the value of all that money. Whereas if you put it into something like, shitcoin, you can lose 100% of it in 5 minutes. And, thank you for playing.
All right, so we have this pornographically overvalued market that's driven by rampant speculators right now. The instrumentation is all wacky because we have very few companies that are masking, the weakness of all the others. Economically, that market is bolted to this teetering huge Jenga tower that you just described, right? So a big question here is, okay, well, like what are some of the factors going to be that could be that last Jenga piece that puts what you think could happen into motion here? And you gave us, one idea with the commercial real estate. You talked also about just how, rates are higher for the past couple of years than they've been in a long time. It's a much more indebted economy. That just works as like a corrosive gravitational force on pulling
Right.
economic growth down. But really kind of
And also taking the tide out on like where all the speculation and debt and like underperforming businesses and things like that are. Like that's corrosive is a very good word, because what it does is, it just naturally eats away at the cushion that people are afforded by cheap money, and that cushion allows underperforming businesses to continue operations. It allows, people to speculate with significant leverage on, things that they're taking losses on. And so the positive real rates, it's, when the economic machine starts to grind slower, which is what these positive real rates do over the course of time, very, very slowly. Eventually, one set of gears somewhere jams up, and that's where you have your first domino to fall. So it might be CRE. The thing is, like, what's going to be the catalyst there? Is it going to be like another major like AAA default? Is it going to be? I just saw a headline yesterday. I forget the company. Been in business 20 years. Miami commercial real estate company filed for bankruptcy. Is it going to be a major, massive S&P 500 company under stress and doing a fire sale of equity the way that Silicon Valley Bank did? It
right.
could be anything.
We don't know. There's lots of wiggly blocks in our Jenga tower here, but as you were saying earlier, like this went on longer than you thought. There's the old time expression that the market can remain irrational longer than you can remain solvent, all that stuff. And part of that you have to appreciate, as I know you do, that if you are betting against this, right? If you're betting on the breakage, you're betting against the entire status quo, right? Because every
Right.
corporate CEO, everybody in Capitol Hill is trying to keep the game going, and they will do more and more unnatural acts to try to keep it all together. But to your point, at some point, the wrong block is going to get pulled, and the whole thing's going to start to tip over. One of the things that's going to be sort of, once it gets started, is going to be a hard thing to stop, is going to be when the unemployment rate starts really taking off here, right?
Yeah.
And as more people start losing their jobs, they can afford to spend less. Everybody starts getting worried when they see their neighbor loses their job, so they pull in their spending, and then that reduces consumer spending even more, and that puts more pressure on corporate profits, so they have to lay off more people, right?
Yeah.
That's where we get there. So I wanted to get to a piece that you recently wrote, where you said the job market just said game over. So can you speak briefly to why you think the signals coming out of there are now so definitive?
Well, the ugly jobs print last week to me seems to be the one of the first real like clarion calls that uh that the economy really is starting to grind slower, because it's something, it's digestible, right? Like some obscure thing happens in the CRE market, like, yeah, okay, like some people pay attention to it, other people don't. The Fed comes in, they sweep it under the rugs, whatever. But to speak to what you're just saying, you made a great point about like how a deleveraging cycle works, like psychologically and in practice, right? Everybody starts hitting the bid, prices get lower, companies have to do layoffs, like it all kind of like cascades at the same
It's a
time.
cascade. Yeah.
But an ugly jobs number and rising unemployment, there's maybe like three or four major macroeconomic indicators that an average person sitting at the dinner table can talk about, can understand, and will be printed in media that isn't just financial media. And the unemployment rate is one, especially when the media hates our president and it's happening while he's in office. So they'll be happy to boast about, how bad unemployment is in the country. That CPI, you know, broad like housing price index moves, like those kinds of things, like
That's
they
pretty
all
much
kind
it.
of
How expensive do things cost? Are my friends losing their jobs or not?
right.
And what was the
But
other one? Housing prices. What's
it's
the cost of my house? It's those three things
but
that the average person appreciates. Yeah.
in this case, like it's both psychological, right? It's going to set off a psychological set of dominoes for people that think, okay, now I'm in a recession, right? Just like people think, okay, now people, it's the baseline now that people assume we're in a period of heightened inflation still, right?
Yep.
So that genie is out of the bottle, and that same thing will happen with recession. People will say, oh, jobs number bad. I'm in recession. Maybe I should spend less. It's just natural behavioral economics, remedial behavioral economics, right?
Mhm.
Very, very simple, like, caveman fucking like grunt and point kind of like, I see something, I do something, right? So the jobs number can kind of set that in motion. But the interesting thing now is what I was saying to you before, which is the passive bid that is directly linked to the jobs market and directly linked to people's number one source of liquidity that they're going to need to tap into, which will be their brokerage accounts and their retirement accounts, et cetera. Um, that happens to be one of the two major legs that's underpinning the market, I think. And so when you listen to, like Mike Green talk about $50 trillion in passive funds, and he suggests that these funds don't even have cash to meet redemptions. They have the assets, but instead of selling the assets, they are taking on some debt because they think, okay, like we'll manage these couple redemptions here with just some leverage, just so we can keep the buying machine going. When they run out of space to take on leverage and they actually have to raise cash and they actually have to hit the bid, and you start seeing outflows, well, then you have like a giant Titanic machine that has been going in one direction for 25 years or however long, starting to go in reverse. And then you have a big problem, and that's tied directly to the jobs number. So I think that the jobs number psychologically, but also in terms of market mechanics, is extremely important. And so now we see this. It's the first brick in that psychological foundation where people are starting to discuss, like, hey, like the economy really is slowing down. And it's like, all right, what's the plan now? CPI is at 2.8. We'll get a new print this Saturday. We get PPI on Wednesday. PPI came in hot on its last reading. We got, what was it, like 0.9 versus 0.2. CPI, whether it meets the estimates or not, doesn't matter because it's still, almost 3%. If you take the official number, if you take so you have inflation essentially running 50% above the Fed's target, still kind of a tinderbox, right? That at any moment, psychologically, people could say, all right, prices are out of control, and without more money printing, could still raise prices. I mean, you look at this stuff I buy. I mean, it's 10, 20, 30% higher than it was a year ago. So, take the 3% number however you'd like to, but like really the economy is experiencing much greater inflation than that already. And then now you're going to have the economy grind to a halt and take the stock market with it. And so it's okay. Like, what happens then? What happens when everybody hits the bid at the same time? Does the Fed print into hot inflation already? I don't know what they're going to do, man.
I'm curious, do you think hot inflation will still be around by then? Or if we get into this sort of, recessionary area, I mean, we could have stagflation, but also it could just kill demand. I mean, we could see disinflation
Yeah,
step in quickly, right?
for sure. I think it may like to the best of the way I can figure it in my head, with my limited understanding of the bowels of the financial system. What I think will happen is, like I said, we'll see a sharp deleveraging, and I think obviously with that, like we'll see like inflation come in a little bit. But the deleveraging in financial assets, it was going to cause things to break, and the Fed is going to have to print.
Yeah.
And then we'll see inflation run rampant after that.
Yeah,
And
basically,
if
you're
we
saying
do,
whatever disinflation, deflation there is, it's going to be short-lived because of the Fed's reaction.
what I'm saying is we're doing 100 miles an hour right now. We're going to slam on the brakes down to 20, and then right after that, we're going up to 300. That's what I think.
Okay. Okay.
So, um,
Well, look,
the
oops,
go
sorry, go
ahead.
ahead, and then I'll build on this. Yeah, go ahead.
It's okay. Go ahead.
Okay, so you took it exactly where I wanted to take it. So the reason why I brought up the whole unemployment thing is because not only could that really get the economy slowing down, but that is the thing that could turn the passive flows. It's got the potential to reverse the passive, slow or reverse the passive flows. And as your point, that's one of the primary pillars keeping up this pornographically overvalued market. So huge potential there. So another question is, okay, well, what could really get the unemployment rate moving up higher from here? And it would be a slowdown in consumer spending. Well, what could drive a slowdown in consumer spending? And there's a lots of things we could put out there, but one that's been on my radar that I think is on yours too is the forced repayment of student loans, right?
Yeah, of course.
Where we're all of a sudden seeing delinquencies on those shoot the moon because they had been at zero for a couple of years, as everybody was sort of promised they would never have to pay these back anyways because they were all going to get forgiven. As you know, student loans you have to pay back. Even if you decide not to pay it back, the government will garnish your wages. So as you're forced to pay back your student loans, you have less money left over to pay for other things, including your
Right.
other forms of consumer debt. And we're already seeing those start to really spike, right? So I guess my question for you is you've just written a piece here called something like Americans Shocked to Learn That Loans Must Be Paid Back, but talking
Yeah.
about this new student loan crisis. Do you see it as much of a potential trigger for decreasing consumer overall spending and therefore spiking inflation, unemployment as I do?
I see student loan delinquencies coming back, and I was looking at the maybe the St. Louis Fed or New York Feds. They put out some whatever their like quarterly report is or monthly report is, with all the charts in it showing credit card delinquencies. It's that the other.
It's the
You
New York
see,
Fed. I know the exact chart you're talking about. Yeah.
yeah, and then everything kind of looks normal, and then the student loan delinquency line just shoots straight up. And I always think about that meme, like, well, if it isn't the consequences of my own actions, like.
Yeah.
And so that was kind of like how I was feeling when I wrote that piece. Americans shocked to learn that debt must be paid back, which obviously is hyperbole or gross exaggeration for humorous effect. However, Americans are actually shocked to learn this because, I had one friend years ago, and I have one friend now that are like shining examples of this. I had one friend years ago who had significant student loans from Penn and had asked me, can I have your advice on what I should do? I just I got some money, I'm trying to figure out this, that, and the other. I said, listen, I don't give advice. Like, she's like, I talked to this guy that our family knows. I said, what did he say? And she said he said to wait paying back the student loans because they might just get discharged. And that was the mindset. The mindset was, this is money I never have to pay back. And then all of a sudden, it is money that you have to pay back. And now, on the other hand, I have another wonderful friend of mine who is basically going through exactly what you're talking about, who's now back on the hook for student loans. And, it has an impact on how she's budgeting herself on a monthly basis. So it needs to be considered. But like when these things go away for a while and then you reintroduce everybody with a new monthly bill that didn't theoretically exist for, 5 years, and you do that at a time when the economy is starting to crack, like, yeah, that's just pushing the snowball down the hill a little bit faster. And so, you said it perfectly, which is that is exactly how discretionary spending slows. If it's not a loss of a job with no, economic stimulus check for no reason from the government, like we had during COVID, shit just gets real and you have to make real choices. Like my friend now, like I'm just I'm helping her kind of make a budget because you get at some point you have to start to look at what your monthly expenses are and what you earn. And once you budget yourself, you're in a good place. But when a new expense comes out of nowhere, it kind of there's aftershocks with all of the discretionary spending that you were, used to putting in place over a monthly basis or a yearly basis or whatever. And so and that's it. Like you said it, when discretionary spending slows, companies make layoffs. When companies make layoffs, people lose their jobs. Those people that lose their jobs spend less. Companies make more layoffs. And all of a sudden, you have this big, beautiful downward spiral in the economy, also known as a recession. And so the difference now is we have blown this bubble so big, both in debt and in people's insane expectations of what they are entitled to with the stock market and the economy. And everybody expects that they're entitled to, like, unlimited comfort when it comes to markets and the economy. And guess what? Like, shit might get real and it sucks, and I'm sorry, but like, it's not even by choice. Like, our policymakers would micromanage things into oblivion if they thought that they could, continue to have everything look utopian forever. I mean, but the natural laws of economics and mathematics, they just don't let it happen. And so, introducing student loans here is just throwing kerosene on that tinder box that I was talking about, and just saying like, because people had trouble paying their bills coming into that, right? Like, we started to see
Mhm.
credit card delinquencies rising months ago, auto loan delinquencies rising months ago, average FICO scores on loans going down, like all those indicators that you look at that show that the economy is slowing. That was happening before it. And now it's just like, all right, just took that match and just threw it right on the tinder box, like, oh, take this too. And fucking good luck figuring it out. So yeah, I mean, it's and nobody knows. It's like, what does he say in Big Short? He's like, everybody's walking around like they're in a goddamn Enya video. And that's it. You turn on the TV and you got the same guy on every day explaining why 40 times PE is cheap. And, so no one is going to save you. I just aggressively try to not give financial advice, but give the life advice to think critically, think outside the box, like aggressively do your own research. Nobody is going to save you, not the sell side, not Adam Taggart, not me. None of these people are going to save you. You have to kind of educate yourself, and you have to have the fortitude to stand up against the whole system and say everything's wrong here, and I'm doing the opposite of what my cousin is suggesting I do at Thanksgiving dinner, because you know objective truths and reality are what's going to uh, determine where the market and where the economy goes. And there's some math that can't be faked, and there's some natural laws of economics that can't be faked, and eventually the truth wins the day. I was a professional short seller for 10 years. Um, and one thing you learn as a professional short seller when you are identifying fraud, or you're identifying, uh, business models that are broken, or management teams that are nefarious, or, you know, one thing you learn is the company always has a story. That
Right.
first press release from the company is always like, oh, the report is misleading and it's
Fake
half
news. Yeah.
truths, and everything's fine and whatever. But then eventually everything gets to a breaking point where it just can't be denied any longer. In the case of Nikola, it was the truck rolling down the hill. People saw that and just said, oh, okay, like, I can understand this. It's just fraud.
Mhm.
Or like Madoff. You keep it going for 30 years. Bernie, 8% every year. We don't know how he does it. He's great. Couldn't be Madoff. He's so close to the SEC, blah, 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 blah. And then one day you wake up and you got a Silicon Valley Bank situation where you just can't make your redemptions. And the SEC was closing it anyways. And so it's just like, well, game's over. And so you can polish and polish and polish dog shit over and over and over again. But eventually, the universe bends to the laws of economics and to the objective truth, whatever it happens to be. And that's what happened with my COVID analysis. And that is what I think is going to happen here with the market.
So I very much appreciate that, and I very much appreciate the way in which you look at the world. It's very similar to mine. I just recorded an interview with Bill Fleckenstein like an hour before getting on with you here, Chris. And there is some world weariness in his response to some of my questions, where he's like, "Look, he's like, the fundamentals just don't matter right now because we were really diving into the passive capital flows." Because he's like, as long as that's in the driver's seat, like none of this stuff that we think about all matters, and you can get
Right.
killed jumping in front of it. Like, God forbid you jump in and short the market, you could get killed as long as these passive capital flows are in control. But, and he puts the same but you do, where he says, hey, look, eventually the objective truths matter. You just have to figure out how to position yourself while you're waiting for that to actually manifest here. And
And you know what? Like right now, with where things are and on the the uptrend that we're on, where you get somebody like Bill Fleckenstein, who I think is, you know, incredible analyst. He's the reason I started a podcast. I'll talk about that in a second. I have immense amount of respect for his analysis. I listen to every single interview that he does. But people now, while we're in this uptrend, no one gives a shit about what the historical average S&P ratio has been over the last 50 years. No one cares that it's whatever 18x or 16x, and that at one point during recessions it dipped to 8x or 6x or 10x, and that would basically mean a 60 to 75%
that correction,
drawdown
right?
in the market. No one cares about that. But what I can tell you is when those passive flows start to hit the bid, those are the charts that everyone's going to pull out and say, oh man, how low could we go? How the fuck did we get up here at 38? Like the historical mean is 16. Then everybody's going to go back to all those valuation charts and be like, shit, yeah, we could go a little bit lower, or we could go a lot lower. So, it's that one harkens back to psychology.
Oh,
And
absolutely, thousand
Bill
percent.
Bill's 100% right that nobody wants to look at that now, and you can get run over. But what I'll tell people is this: I started a podcast, and Bill Fleckenstein was my first guest because of how Bill Fleckenstein was treated during a CNBC interview that he did in 2016 or 2015. I don't even remember. But when I started to figure out macro, and it became clear to me that the whole thing, at least to me, appeared to be a Ponzi scheme, there was only a handful of people that ever were on financial media that sounded like they made sense to me, and
Hmm.
he was one of them. And he did an interview on Fast Money in 2013 or 2014 where they asked him to come on, and then Tim Seymour ridiculed him. Said that his words were pathetic, because Bill was basically saying, hey, like, you could look at the market's really overvalued, and I'm in gold now, and to Seymour's point, the market has just gone straight up, but he called him pathetic. And Bill made 2 points during that interview. One was one of the bond markets is going to crack up. He said maybe Japan first, and that gold was going to go a lot higher. And Tim Seymour kind of was jabbing at him and said, "Well, gold was like 1,300 at the time." He's like, "Well, what do you think, Bill? Like, is gold going to $2,000 an ounce? Like, give me a break." And of course, now gold's at fucking $3,500 an ounce, and that was maybe 10 years ago, if that, So the point is, like, Bill knows what the fuck he's talking about, and like, he's right, and he's going to be right about the bond market too. The question is just timing, and when that does happen. And he's adapted, I think, like I have, from really kind of like what I would say be like permanently bearish on the market to kind of surrendering to the idea that in nominal terms the market may always just go higher, but that doesn't mean that we're not in a recession, and it doesn't mean that the market priced in gold isn't down 60%.
Right.
um I think he gets it, and he's just kind of adapted a little bit in the same way that I have to hedge and to tell you, like, hey, you know, the market could just keep going up. But I think his analysis is 100% on point and astute. It's just, you know, this isn't as Brent Johnson would say, this isn't like an exercise in like free market on paper, theory in a vacuum. It's a world where governments intervene and everything is micromanaged. And so you have to kind of solve for X, but then you have to run that through like the assembly language to get to the answer of what happens after all of the central planners get involved too. So there's like a sick, like psychological part to it too. It's like the market. Bad news isn't just bad news. Bad news is good news in the market, because bad news is bad news until it meets that assembly language, which tells you that the central planners will stimulate markets. And then all of a sudden, bad news is good news. So you have to do equity analysis followed by psychological analysis
Analysis,
afterwards.
right?
Yeah,
Exactly.
like
And then you also have to figure out.
what are a bunch of lying, dickless cowards going to do with this equity analysis? You have to take that and then say, okay, well, like here's what these scared shitless people who run up from the desk at CNBC when things go wrong, or the Scott Wapners who tweet during COVID to shut the whole stock market down and start over again in 2 weeks. He posted something like that. What are those people going to do with this equity analysis that we have? And then that's your answer. So I think Bill is just qualifying for that. I I love Bill. I respect the shit out of him, and I think everybody should listen to everything he says. I listen to every single word that he says.
Well, thanks. I do too, and I did not realize that he was part of your origin story there, and it's such a great anecdote. I'm so glad you shared it with us. It ties to something that John Hussman has said in the past, which is bubble markets force you to make a choice: look like an idiot now or look like an idiot later. And that's what makes the psychological part of this so hard. Is to Bill's point, it's not mattering right now. It hasn't mattered for a good while, and it might still not matter for a good while from here. And it's really hard if you are educated in the history of economics enough to know to see the instabilities that you're talking about, but
Yeah.
still see the market go up every day and see your idiot brother-in-law who's just basically throwing darts, at Dogecoin call options, more or less, and
Mhm.
making money hand over fist, right? But where the rubber meets the road, and this is why I appreciate
Oh
so
my
much what
God,
you,
I made $3 million yesterday. Like there's there was
yeah,
a scene in the movie Orange County, which is an obscure reference. But there's a scene in the movie Orange County where everybody in high school is getting their college entrance like letters, and get all mixed up, and people get the wrong ones. And some ditzy cheerleader's like, "Oh my God, I got into it," and she's trying to read it. Yeah, like it's the same deal. Like, oh my God, I fell ass backwards into $3 million buying a crypto that should have a bid of zero at all times that produces no product or service. That's where we're at. Husband's
right.
a
That's where
genius
we're
too, by
at.
the way.
And it can be so and the hard part though is like, and again, this is why what I do what I do, and I think it's what you do, which is, the majority of people watching this video, Chris, are 45 years and older, right? And so if we do have this repricing event that you think is likely to happen at some point, we don't know when, right? But it's likely to happen at some point. A lot of those people don't have a lot of time to recover from massive losses if they walk into that event just sort of blindly long the market, right? So, it's a very difficult time for investors, one, to understand what's going on for all the reasons we talked about, but to try to figure out, okay, how long do I be in this market? And how do I be long, right? So you have definitely said, well, look, I'm going to be long basically things that can't be inflated away, right? Hard assets are a big part of your portfolio allocation, right? So I just want to acknowledge, like, it's a tough time for folks to figure out what to do. But the key thing to your soliloquy there, Chris, was, hey, like, even though it looks like it's sunshine and roses forever, remember that these forces of nature will eventually re-express themselves and they will matter. Last major question for you, and then we'll start wrapping up. So you said at some point they're not going to be able to rescue the system, and we'll have this corrective repricing you talked about. One thing that sometimes gets probably that's more frequently getting thrown out is, well, this actually might, come to the rescue in time, is AI. And I'm just curious on your high level thoughts on AI. Do you see it more as something that can ride to the rescue by creating this, renaissance in productivity? Or do you see it more as a danger in terms of maybe having created a bubble of a lot of phantom market value that could go away in a heartbeat here, and or a massive jobs destroyer?
Yeah, I think the tip of the speculative spear right now in markets is crypto first, but then I think the AI bubble kind of runs a close second. There's there's some similarities in the sense that crypto requires a significant amount of computing power. Well, Bitcoin specifically, I happen to think Bitcoin could make it longer term, but the crypto market's $4 trillion. Bitcoin is, let's say, 2 or 2.5 trillion, which means there's $1.5 trillion of just pure detritus and crap in the crypto space. Your Fark coins, your Shiba Inu, your Dogecoin, all this bullshit. That will all get wiped out eventually. Similarly, in the AI world, I think that AI is here to stay. I think that, eventually it's going to get to a point that is going to be fucking scary when we reach AGI and this thing can just start building on itself. And thank God I'm 42 and I'll be dead, at some point relatively soon, because I'm not really interested in like living through the like humans versus machine war, which inevitably feels like it will happen. I just feel kind of a weird like dystopian thing to say, but like I don't know, it really doesn't seem like too far fetched of a prediction for 100 years from now. So if it's the year 20 into 21 25 and you're watching this interview, then like just if I got it right,
Yay,
just stop
humans.
by,
Glad we made it.
yeah, stop by my corpse somewhere, put a flower down or something. But I think that here's what I think the biggest risk in AI is. As far as like black swans go, I can't help but notice that NVIDIA has some interesting relationships with companies that feel circuitous. For example, CoreWeave is the one that everyone has pointed out, which couldn't find a bid at its IPO at $40 per share. NVIDIA had to come in and basically backstop the IPO. They have like a pretty, they're like NVIDIA's key customer. There's, chips being shipped back and forth and back and forth. You got one company with a 40 times earnings valuation that is basically single-handedly, the predictor of the direction of the entire general market. So goes NVIDIA, so goes the NASDAQ. And the other one is a speculative kind of black box that nobody really understands. And, I guess they're a reseller. I mean, it's just, I don't know. It doesn't feel right to me. And that's just from spider senses of 10 years working on the short side, generally being a skeptic in general. The whole Nvidia thing, I don't know, it doesn't feel right to me. That CoreWeave's got this big like customer concentration risk. um it's fascinating. Like, this is what I mean when I talk about market distortions. You have a company that IPO'd at 40. Okay, couldn't find a bid at 40. So its largest working relationship in the market, Nvidia, comes in and sets a floor at 40, and then it trades to 150. Where's that bid come from? How's that for a fucking question? Like, did business really improve over the course of, 2 months? No, of course not. Rampant speculation. And who knows? Convenient that that happened for Nvidia, who backstopped their IPO at 40. But I don't know. I can't put my finger on it. But to me, something just doesn't feel right. And so I would say that AI is in a bubble. I think there's a lot of like quantum computing names, and there's a lot of just tech names in general. We're seeing a return of SPACs, like non-cash generative crap, pre-revenue companies. I mean, look at what happened with like all the EV makers, like Lordstown Motors, when we had the EV boom came out. And like, yeah, what did we find out? Well, we found out all the pre-orders were completely like did
Mhm.
not exist. They were from one person LLCs that went back to some guy's bedroom in his apartment. Like, so when a trend catches on, there's always people that want to ride the coattails of the kings of that sector. At that point, it was Tesla. So everybody kind of wanted to follow Tesla's model. Now it's Nvidia, and you have these other kind of, you have Supermicro, you have CoreWeave. There's some kind of critical questions floating around there. Um, and so I don't know. To me, the entire market feels like it's in a bubble. I think, the idea that the productivity gains from AI are going to justify today's valuations. It's just, when you factor in the amount of jobs that will be lost as a result of AI, and the fact that I can't even get my fucking Siri to tell me what day it is. You know what I mean? Like five times a day, I'm trying to be a man of the future, and I reach down and I ask my watch something stupid like how many days are in November, because I'm writing out a calendar, and it's like, I don't know, but you can log onto your iPhone. If that thing can't just say to me 31, something that's fucked. Like the shit doesn't work the way that it's supposed to yet. All right. So between that, the fact that it's not necessarily going to be additive to the jobs market, and the fact that there's a lot of companies that I think are riding the coattails of Nvidia that likely don't deserve their valuations or to even exist. I think just in general we have a broad, pretty wide overvalued market full of crap. And we are so overdue for a real deleveraging that just, this market needs to shed its skin so badly. Every third company is like a total fraud or not generating cash or just a story stock. So I think everything's in a bubble, to be honest with you. I just think that AI, you know what AI is? AI is the bullshit excuse that cowardly sell side analysts who make ridiculous projections about the stock market without admitting to clients and the greater public that the market is a rigged game fueled by the Fed. It's a way for them to justify the market overshooting their predictions. That's what I see
That's their get out of free card.
right. That's what I see
Yeah.
as notes. Morgan Stanley says, look, okay, January 1st, S&P's at 4,000. Morgan Stanley says their projection for the year is 5,000, which is like, nobody should ever pay attention to these fucking things. Because every time the market goes down, we always look back at those projections like, oh, no, nobody saw COVID coming. Nobody saw this happening. Market's at 4,000. Market goes to 5,000, in 6 months and goes to 6,000 by the end of the year. Now, some analyst has got to get on TV and explain why the market overshot his target by, 100%. So he's got to say, well, this AI is really driving a lot of productivity. We're on the cusp of the future, whatever. Meanwhile, again, I can't get my fucking thing to tell me how many days are in November. So like, it's a way for people to backfit an explanation, a bullshit explanation for a market that is just completely distorted, by central planners, by insane market participants, by everything, by passive bids, by the options market. So I don't know if AI per se is going to be the thing that pops the bubble, but what I would say is, man, it sure would be a huge problem if something happened to Nvidia, wouldn't it? Like, it sure would be a massive shock to the system if we woke up, and it doesn't have to be Nvidia, it could be Tesla, it could be Amazon, it could be Microsoft, but these seven companies that are driving the market, it sure would be something if all of a sudden somebody, some auditor filed a letter at the end of the year one year and said, oh, we got to look at something, or, and these kind of things, they happen, or, hey, there's something going on with this relationship. We don't know. It's just human behavior. It happens. And there's, I'm not going to say fraud, but there's problems under the surface, whether it's mismarked books at CRE companies or revenue recognition problems or cash balances that don't exist. These things are already there, and people have been actively trying to cover them up for months, if not years. I'm certain of it. We just don't find out about them until we have that oh shit Madoff moment
Right.
where it's like, okay, there's nowhere left to hide. So people will lie and lie and lie and cover up and cover up and cover up and swear that it's the Austrian economist's fault, that it's the gold bug's fault, that it's short speculators in the market, that it's this, that it's that. But at the end of the day, there comes to a point where they can't run, they can't hide anymore. And if there's a moment like that in one of the Mag 7 stocks, I'm not saying there's going to be, but if it does happen, that certainly would be a fuse that I think could set off major problems. As far as AI directly, can I point to something and say, like, well, I really think that AI is, honestly, like I said, I think that crypto is the tip of the speculation spear, and where I think we'll probably see a major deleveraging first, but then tech stocks are like right after that. So the one good thing I see from AI is it's moving people towards nuclear power, which I think is the future. I think nuclear has gotten that. It's done very well over the last year or two. My subscribers have known that I've been very bullish on nuclear for like 3 or 4 years now. But we're going to need a lot of power going forward. And so I think there will be jobs in the energy space for sure that are created. But like I said, I can't say AI is going to be the pin that pricks the bubble, but there will be a pin.
All right. Well, look, we're going to have to end it there. Great points. I agree on a lot of what you said there. A lot I'd love to dig into, but we're going to have to save it for next time. Chris, there were some other recent posts of yours that were kind of more life related that I was hoping to get to, but we'll just have to get to them later. But you had a great piece
Which one?
about how
I'll give you a 2 minute. I'll give you a 2 minute analysis. Which one?
Now, you know what? Let's save it to do justice, and we're already well over time here, so I got to let you go.
All
But
right.
this was the one about every industry is
Boo.
an airport lounge now, and then you also had one about the whole tipping culture, and I was like standing up at my desk applauding after I read that one, which is, hey, it's just time to start saying no to, the crazy out of control tipping culture. I mean, yes, obviously tip the person who's provided actual service to you, but beyond that, we're done. All right, look, in wrapping things up, the most important question, Chris, which is for folks that have really enjoyed this discussion, maybe this was their first introduction to you, and they'd like to follow you in your work, where should they go?
My Substack is called QTR's Fringe Finance. So it's quothetheraven.substack.com. You can just put in QTR's Fringe Finance and it'll come up somewhere. And about half of what I write is free and half of what I write is paid. So you can come over and check out all the free stuff. I also curate content. So um, pour through a lot of like libertarian and Austrian school, think tanks, some of my favorite analysts, some of my friends that are hedge fund managers will give me their letters, will give me their analyses, and I'll post a lot of those things as well. And I write, I consider myself a columnist, really. Like I write my own kind of column today. I wrote about the tragic murder in Charlotte about 2 or 3 times a week, and about half of those are free to read. So you can come over and read whatever you'd like for free.
All right, great. And you're on X as well, right?
Yeah, at QTR Research.
All right, great. And Chris, when I edit this, I'll put up the URL and the handle, both your Substack and your X account on the screen there so folks know where to go.
Cool.
Folks, the links will be in the description below this video as well. Um, Chris, just such a joy to meet you in person. You definitely did not disappoint in terms of being specific, bold, and colorful in your presentation, and in digestible and concise. So I very much appreciate all that. Just because folks are going to, I think, bring it up in the comment section, 30 days in November. So just know that everybody's going to jump on that. It's 30 days in November.
That's
But
why I
real
was
quick,
asking.
yeah. And hey, that's a human beating AI apparently in this story. And us humans need as many wins as we can still put up on the board. But anyways, Chris, so fun. Thanks so much for coming on the channel.
Yeah, thanks so much, man.
All right. Well, now's the time of the program. We bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined this week by John Lodra. Senior partner Mike Preston has the day off. Hey, John, how you doing?
Hello, Adam. How are you? Great to be with you. And I'm sure Mike's enjoying his vacation this week.
Good. So Chris Irons, colorful character, huh?
Absolutely. I stumbled upon Chris, I don't know how actually, several years ago. And he's been in my Twitter or X feed, whatever you want to call it, for years now. So I was thrilled to see him come on your channel because a couple of things we really appreciate about he's certainly clear spoken and outspoken and doesn't hold punches, and we really like just candid, truthful talk. That's what we as advisors try to do, maybe not in the same style but in the same spirit. And look, there are things to call out and observe about financial markets that can't be danced around or sugar-coated, and we just really appreciate folks like him calling out some of the things that we as well see, that our takeaway is it's only inevitable will matter at some point, and we're probably getting closer to that some point than we have been.
All right. Well, what I really appreciate about him, especially his writing, but certainly getting a chance to talk to him live for the first time, is he has come at this macro world from an everyman's perspective. He didn't rise up through getting an economics degree and then going to work for a hedge fund and going to get an MBA or whatever. And those of us who do, many of nothing wrong with that, and many of those folks I interview on this channel, we sometimes can get ourselves wrapped around the wonkiness of the topic, and we use a lot of highfalutin words, and there's a lot of kind of spiraling around what could happen or what might be going on. And Chris really just has a way of cutting through all that and just stating, what the every man would say if he were at the table. Hey, I don't like that. That doesn't look like it's going to end well. So, obviously folks just saw that in action, so don't need to dwell on it, but it is sort of a refreshing breath of fresh air. All right. Well, look, he used a great turn of phrase to describe the overvalued state of the market in his mind, which was pornographically overvalued. And I don't think you would disagree, John. But curious, what were some of your key takeaways from his economic outlook?
Yeah, so first of all, Chris does bring an everyday person's take to this, but it's a very informed take. He brings data, which is something that we always try to do ourselves. It's so easy as humans, whether you're a professional investor or not, to succumb to your own psychology and biases and this and that. So the ultimate arbiter is data, and you can take data and you can rationalize and explain away, why things maybe don't jive with the data, but you got to at least start with an informed perspective. And we think data, black and white data, is the best way to do it. So he brings a bunch of that, and not only your talk with him, but in the writings he puts out. So yeah, pornographic is a very apt term. Obscene we've used. I mean, we are categorically at the most overvalued point in the U.S. stock market in history, and some of that may be partially justified in some sectors. With kind of the hyperscalers and the huge margins. There's all kinds of rationalizations that you can, but history is replete with this time is different kind of mantra, and they're all always very seductive mantras, and they don't matter until they matter. And I think the one unique thing, if I could even use that word, in this latest syndrome, and I would describe the last 15 plus years as being symptomatic of this, is we've had absolutely massively distorted monetary and fiscal policies in succession. And they have created a beast of a market that is in the numbers you look at, valuations and all this kind of stuff. And so we're absolutely on the same page with what Chris talked about. That'll matter at some point. Valuations don't matter in the short term, but they matter in all of history with the long term. And they are not immune from the laws of gravity. In fact, when you look at all the rescues that the Fed and other policy institutions have done, they've been in the wake of major calamities. And it's ironic that like, for example, the Fed will get credit for saving the world from the great financial crisis, where a very studied opinion would be that the Fed's policies, low interest rate policies, were in no small part a cause of that bubble. That and the kind of legislative policies to make home ownership accessible to everybody. Well, that sounds great on paper, but when it manifests itself by Wall Street taking the bit in its teeth and doing no doc loans and loans for anybody that had a pulse, and even folks that weren't even real, that's what you get. You get a bubble and it explodes, and the rescue comes to the table in the form of the Fed and monetary policies. It's just a vicious cycle. We think our takeaway is very similar to Chris's. We think ultimately there'll be a very massive reckoning in markets that will be once again met with monetary and fiscal response that will just have to make one bad choice higher than the other. I think his take, and seen in his writings, is that they'll come to the recent job numbers do suggest that there's some real kind of degradation in the state of the economy. The job market is soft. It's getting softer. And that will likely be the cover for the Fed to cut rates like the market expects it to, with near certainty, or absolute certainty, I should say, in next week's Fed meeting. But the policymakers, we have no doubt, will choose economic and job market health over, for example, worrying about inflation. And that is a stew that I think can invite a very, very tricky environment. Call it stagflationary like the 70s, whatever. But it's a nasty time to be kind of an investor. It's a very tricky time, and we think passive buy and hold is likely not going to be the same kind of victor that has been in the last 15 years.
So interesting that you used the term tricky. That's the term that Bill Fleckenstein used when I interviewed him earlier this week, for many of the same reasons you just mentioned, John. And when I brought that up in the discussion with Chris, he talked about sort of his origin story, and that Bill Fleckenstein was actually the first guy he ever interviewed for part of his business. So there's a bit of a full circle that's going on there. You mentioned the jobs data, that of late the drumbeat's been pretty darn negative on jobs, and we had the huge surprise Yesterday, with the payrolls coming in far lower than was expected.
Mhm.
Or sorry, no, the payrolls came in far lower than was expected last Friday, but they had the jobs revision for the year ending March 2025, and it was almost a million jobs that were removed from the data, right? We overcounted by a million jobs. Um, Biggest revision in history. The last time we ever saw a job revision anywhere near that scope was right before heading into the global financial crisis. And yet, Wall Street doesn't care. Stocks didn't do anything yesterday. They're up a little bit today. So, right now it's kind of a bulletproof Teflon market that just doesn't seem to care about this stuff. And not only that, but I talked about AI a little bit there at the end with Chris, and he certainly seems to believe that it's in a bubble. By the way, folks, uh, you're probably aware of the macro pass service that we offer to Thoughtful Money's premium Substack subscribers, which is sort of a rotating series of research reports that a lot of the folks that I interview here write. Brent Johnson just wrote an excellent one on why AI looks like it's in a bubble. It was a really deep comparative analysis of previous manias, previous price manias that we've seen, and then basically looking at what are the key factors of a mania, and then looking at the AI space and saying, are we meeting those criteria now? And it really is a pretty, it's excellently written piece, but it's pretty condemning for AI. And within an hour or two of Brent publishing that report, we then had Oracle at give its earnings call and gave its forward. It actually missed expectations for the quarter, John, but it gave its forward guidance, and the stock, as we're talking right now, up 40%. This is a this was what, like a $650 billion company yesterday, and is now what, 900 something billion, maybe closing in on a trillion in less than 24 hours. We've just added whatever that is, right? 350 billion in market value in less than 24 hours. Um, Hard not to see this as a bubble-like when you've got movements like that. But before that news came out, I had published a report on X of a stock yesterday that announced it was going to start like a crypto treasury. So some Bitcoin, some Solana, some Ethereum. The stock went up at one point during the day by more than 2,000%. Crazy. They're not doing anything that's creating any value. They're just basically, changing how they invest the treasury aspect of the company. But it went ballistic, and that's a sign of a bubble. But when you have a massive kind of blue chip company like Oracle that can go up by 40% in a matter of hours, I mean, I've almost never seen anything like that before, John. Have you?
Very rarely. I mean, you're exactly right, Adam. It's one thing to see a small emerging company kind of, because the analysts don't really have a full handle on their company model and the business model and the growth rates. But this is, as you said, this is as blue chip as you get in the tech space. And I honestly haven't digested that report fully enough yet. I do know that it was just blow away guidance relative to what the street was expecting, and it's just kind of head scratching, frankly. But when we have seen this happen in prior instances, maybe not the same degree, but these are the kinds of things you see at very speculative turnaround points and blow off top kind of environments, and that's kind of the environment we think we're in, with the backdrop of valuations, the very almost unidirectional move of markets off the April lows. I mean, this is you can't you look back in all of history really and find something as dramatic as we've seen, and not just the move, but like for example the relative move of speculative stocks versus like low volatility high quality stocks. It has been absolutely eye popping, right? So this is just emblematic of investors in mass having this kind of speculative fervor, and that's what you get these unexplainable moves in a big stock like that. And will be interesting to see if this sticks. It would not be without precedent to see this be a, kind of a, we might see an island reversal as we call it, where the stock is, got a daily bar just up there all by itself, and in a week or two we see it's completely come back to earth right from where it was. But remains to be seen. We're not that smart to call that right now.
Okay. I mean, as a capital manager, what does that do to you in terms of um, what's your reaction function to that going to be? Just mild interest and we'll keep an eye on it? Or, hey, I got to jump in on the AI trade now because it's still going gangbusters? Or, hey, this is sort of a classic late stage bubble sign. We might want to de-risk further than we were planning on.
Yeah, well, we actually have exposure to the technology sector, so we're not out of the AI trade. We're not following it per se, but we have broad exposure to an equal weighted technology ETF. So that ETF, even though it's not Oracle, I'll just pull it up, and this is not an endorsement of that ETF, but I'll just show you what that looks like and some of the things we look at. So we've been in technology for quite a while as an overweight sector, in part because it's just been absolutely tearing on a relative strength. We actually think, for example, energy is fundamentally more undervalued than technology by a long shot, but energy has been one of the laggard sectors for all of this year. And it doesn't matter what valuations say if the market's not kind of taking things in the right direction on a relative basis. So we've been in technology stocks. I'll just pull up a chart of the ETF that we own a piece of. It's XNTK is the ticker symbol, and it's essentially an equal weighted technology sector. But you look at this is a daily chart. It's been very strong. Here's today's bar, right? We have this gap open here. That's in
Hmm.
large part due to things like Oracle. Even Nvidia is up big again today, right? On a relative basis. That is, I mean, we're just the things we look are for extensions. These various lines are moving averages. This green one is 50-day. This kind of bluish one is a 21-day. This red line is what's called an upper Bollinger Band. It's two standard deviations move above this 50-day. Rarely do you see this ETF, for example, get above that 50-day upper Bollinger Band, not only at all, but by this degree. So would it be highly likely to see this pull back or at least trade downward to sideways for a short period of time? Absolutely. It's rare that these kind of breakaway gap opens on a broad sector like this stick. And even that stock, if we look at Oracle, I'll just show you what that's doing while we have these charts up. This is the bar for Oracle. I mean, that's crazy to see a stock of that magnitude move higher by that much. How wrong could analysts have been on the business plan, right? But based upon one report's kind of projection, what happens next quarter, right? Are the same kind of blowaway numbers going to be communicated? So Wall Street analysts have a tendency to overreact in both directions, and I think we're seeing that market reaction right here today. I'd be surprised if we don't see this kind of consolidate from this gap open here today.
Yeah, it's crazy because Oracle shared the forecast last night, and I think the stock was up like 30%. That momentum has continued so far here in the day. But I mean, it's I think largely unvetted, right? I mean, it takes time to go through company forecasts and find out what their underlying assumptions are and run your sensitivities and all that stuff. But right now, they're just taking it as gospel, which again, to me, that seems very consistent with previous manias where everybody just sort of relies on narrative, right?
Yep.
Oh, you're telling me? Okay, I'm going to take it as gospel. Yeah.
In these kinds of environments, higher prices beget higher prices. Shoot first, ask questions later, right? That's kind of what happens in very late stage speculative advances.
Okay. Well, look, the conversation with Chris went a bit long, so we'll keep this one somewhat tight, John. But real quick, just back to my question there. So, uh, I mean, last time we talked, you guys had shared how you'd done some risk mitigation. I think maybe you've actually done so on gold, which we'll talk about in just a second here. But just overall, is what you're seeing in some of this bubble-like, this very recent bubble-like moves, is that influencing you to be any more leaning into risk mitigation yet, or are you still assessing?
We're actually kind of unchanged. We had our weekly investment committee meeting today, and we didn't make any incremental increases in exposure by any means. And we kind of kept our current hedges in place. We haven't added more robust hedges. But we are seeing in our systematic indicators some erosion. So for example, we look at a whole battery of breadth indicators that kind of give a pulse on not just what the top names are doing, but what is the market in mass doing. So the S&P people forget the S&P 500, for example, includes 500 companies, not just seven, not just one, but there are 500 companies. So we can kind of look across that whole universe and see what's happening. So, for example, if you look at the percentage of stocks in that 500 stock universe that are trading above their 50-day moving averages, we are seeing a series of higher highs, lower lows, and lower lows. Let me just pull up a chart of that just to kind of give you a sense for what we're seeing. So here we go. This is a chart. It shows the percentage of stocks in the S&P 500 that are trading above its 50-day moving average. Okay, we peaked out in July at about 78%. What we saw, so going back even to April, we saw a washout in April that was on par with some of the worst declines in all of history, a capitulation, you might call it. Only about 4% of the stocks in the S&P 500 were trading above their 50-day moving average. Since that time, and the market's bottomed, I think, on April 8th, I want to say. But we've had a very powerful move higher, very broad rally in the stock markets, not just the Mag 7, tons of stocks, and to the point where 78% of the stocks in the S&P 500 were trading above their 50-day moving average. That has systematically started to turn over here. So you see these lower highs and lower lows, and we are looking like we're going to put in some further degradation there. These are the early warning signs that the momentum is starting to wane. So we are looking very closely at that and a whole battery of indicators that tell us that, hey, this kind of speculative advance, this momentum is starting to wane. So we probably would greet that with a reduction in equity. We have one holding in our equity portfolio right now that we're probably, I would describe it as in the penalty box, and that would probably be the first area we start to trim. And we have some put options, out of the money put options that expire next Friday. If we don't see this turnaround, we'll probably look at extending those out, maybe adjusting the strike prices higher. All to say is that we're probably closer to trimming equity and or broadening our hedges, given what we're seeing in the broad indicators here.
Okay. All right. So let's specifically now then get over into gold, which has continued its epic run here. Gold futures ticked $3,700 an ounce very briefly yesterday, the day before. I can't remember which day now. But a number that I think almost none of us thought was possible, coming into this year. I mean, we all hoped eventually it would get there, but to get here as quickly as it's gotten here has really been a joyride for those that have been invested in the precious metals. One of the questions I've been asking of late, folks on this program, which I'll now ask you, John, is, precious metals investors are feeling very validated, rightly or wrongly, especially a lot of the folks that have been holding them for a long time because they've been concerned about, currency devaluation and things like that. And there's sort of a sense of, all right, this is it, right? And maybe it is. The question I have for you, John, is when things move this far, this fast, my understanding of sort of best practices of investing is you want to rebalance your portfolio. You want to take some of those great gains off the table just to make sure that you don't lose them in case things reverse. You oftentimes see pullbacks after big runs like this, and sometimes you see some of the biggest pullbacks in the biggest bull runs, right? So are you guys lightening your position or hedging your position any more today than you were, say, a month ago?
Yeah, to answer the question bluntly, yes, we have taken some chips off the table, both in a trimming of. So we've had gold mining exposure and some silver exposure, not gold bullion. So mostly our exposure has been about 12.5% target allocation, 10% of that in gold mining stocks, and 2.5% in silver bullion. Both have had very impressive moves higher. And I'll talk about in a moment, but we have trimmed our gold mining position. It got a little bit overweight. We trimmed that back to model weight and actually have we now have some in the money calls on half the position. Effectively, our gold mining position right now with the effect of those calls is about a 6.5%, 6.25%, 6.5% allocation, because those in the money call options provide nearly about 10% downside protection. If the gold mining complex were to pull back 10%, those in the money call options would protect roughly about the first 10% of that move. Okay. But let me pull up a couple of charts here just to kind of give you that in living. This is a chart. Let me just hit the share button here. This is a chart of GLD, which is the the most widely traded ETF that tracks gold bullion. And we've been talking about, and this is a weekly chart. Each one of these bars is a week. So for the last, since about April, mid-April, we've seen gold itself really consolidate, kind of go nowhere, so to speak. And we've traced out this kind of triangle. Just in the last couple of weeks, we've seen a massive breakout of that triangle. So gold itself, that's a weekly chart. I'm just going to move that to a daily chart. You can see we busted way out above the Bollinger Band. So yeah, we got extended here on a very short-term basis, and the gold miners even more so. But that big picture, this is a very healthy breakout, but we would absolutely expect a high likelihood of a pullback here in the near term. That's not a guarantee. It's just probabilistically speaking, it's become more likely. If we look at GDX here, which is a basket of gold mining stocks that we own, this has gotten even, and I'm going to go to a weekly chart on that. You can see we've had a very powerful move, broke out from this consolidation pattern here in early August. Very sharp move. It is extended up above this Bollinger Band. The RSI got very extended. Fund flows were, if there's one, saving grace here, the fund flows haven't been all that dramatic. So there hasn't been this massive piling in. So there is a possibility that we're early on and climbing a wall worry here, but this is not a binary thing. So we've taken some chips off the table. We have call options written at $63 a share. That gives us a called return up to 65. So on half the position, we're a little bit, we're in the money and our return is capped, but we have protection down to about here on that half. So we think it's pretty likely we'll see a pullback here in the short term, and that would give us an opportunity to roll out those calls, book profits on them. But we feel very confident or very comfortable in having not only sold down the position a bit, if some clients got up to 14, 15% allocation, we trimmed them back to 10% target allocation, and then also sold these call options that brought in premium that still preserves some upside but provides very robust downside protection on half the position.
Okay, I appreciate you walking through that. I've been advising people who have big precious metals positions that have grown, as a percentage of their portfolio over the year, to consider what they might want to do here to de-risk. And some people have said, hey, the logic is sound. I get it. It's just kind of the brass tacks of good wealth building to do these things that you just walked through, John. There have been others who have said, what are you talking about? Right? I'm never going to sell any of this. And this is because the dollar's dying and this is it. This is the breakout moment. Why would you get off right when things are getting going? So I appreciate you being transparent about what you guys are doing there. And, I don't get a sense that you are any less, kind of bullish on the longer term prospects of the precious metals. Again, you are doing what a good capital manager does, which is when things look like they're richly valued, at least in the short term, you take a few cards off the table, you build a little bit of dry powder so that if there is a price correction, you can deploy back in at lower prices, correct?
Absolutely right. There's no single asset that anybody, if they're thinking objectively, should have 100% of their money in, or even 50% in our opinion. You might get it right in some scenarios, but there are certain other scenarios that you just haven't allowed for that won't be the best solution. So yeah, the hardest part in investing is not buying. It's no having the fortitude and discipline to sell. And this thing we call investing, there are infinite opportunities for regret. If one is humble and realizes that even with a very sound system, you're not going to get it perfect every time, you are absolutely going to have opportunities for regret. You're always going to, sell too early or buy too late or whatever. And that doesn't matter. The important thing is that you catch the trends and capture most of the upside and mitigate most of the downside. That's really the imperfect game here that most people really should be shooting for, not getting out at the very top or getting out at the very bottom. That is impossible, nor is it necessary. And having some discipline to sell and book profits and protect some gains is absolutely part of the game.
Okay. All right. Well, in the just remaining minute or two we have left, John, we can go deeper into this next week. But you mentioned energy earlier. That's coming up more frequently in the discussions I'm having as a sector that has really fallen out of favor right now, is really underperforming. but that has a lot of potential promise ahead of it, both if you just look at the cyclicality of the sector, but also if you look at some of the fundamentals that folks like, natural resource investor Rick Rule talk about how even if demand just stays stable from here for the next decade, which of course it won't, it'll go up. But even if demand, say, for oil stayed stable, he's predicting we're going to have some pretty serious supply shortages just because of a lack of CapEx investment over the past decade or two. But right now, oil is basically trading as if it's going to be cheap forever. So, what are you guys? How are you looking at the energy sector right now? I know you mentioned you're getting interested in it, but it doesn't sound like you've made a commitment to start increasing your exposure to it. What are you going to look for to say, okay, now it's time to actually put more of it in the portfolio?
Yeah, so we have not been in energy, and we have some pipeline kind of companies, master limited partnerships in an ETF fund. But the broad energy sector, no, we haven't been really weighted in at all in a targeted way this year. And that's almost all because they've been laggard on a relative strength basis. They have absolutely not triggered any buy signals relative to even the broad market. So that's kept us out of them. But what we're starting to see is some very notable improvement there. Let me just share a chart. This is what's called a point and figure chart, and 2025 starts here. You can see prices. This is an ETF that is the S&P Oil and Gas Equipment and Services Company. These are drilling type companies, offshore rig companies. And to your point that Rick Rule made, yeah, there's been an absolute slowdown in investment in these kinds of things. And that usually breeds a supply and demand pinch that brings prices higher eventually. We're starting to see this sector start to perk up. We've had a couple of breakouts here to the upside, a trend change, and we're starting to see some notable improvement on a relative strength basis. So the early stages of improvement here are in place. And that is right now amongst one of our top shopping list items to look to rotate into if we see some further follow through to that. And what would cause that? We'd see a slowdown and not necessarily decline or a collapse, but a slowdown in the pace of expansion of the broad market while this is starting to gain ground. And that's enough to trigger what we would call a relative strength buy signal in this sector. And we've seen some notable early improvements there that, pretty good chance they follow through, and we'll be looking to rotate into there.
All right. Well, let's keep our eye on that in the weeks going forward. And if you end up seeing that buy indicator, obviously let us know and let us know what you guys are doing so folks can follow along. All right. Well, look, folks, if you enjoyed the interview with Chris Irons, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help in trying to figure out how to navigate a market that Chris believes is pornographically overvalued and sort of on a collision course with a lot of the shoes that he talked about that he thought he has high confidence are going to be dropping from here. I highly recommend that most people watching this video get that help from a good professional financial advisor, but importantly, one who takes into account the macro concepts, risks, and issues that Chris and I talked about and John and I have talked about here. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't have one, or you just like a second opinion from one who meets that criteria, then consider scheduling a consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to John and his team there at New Harbor Financial. So to set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill it out. There's no cost to it. There's no commitments involved. It's just a free service these firms offer to help as many people as possible. Also, if you have yet to buy your ticket for the Thoughtful Money Fall Online Conference, tickets are still available at our lowest early bird discount price. Want to make sure everybody who can get that low price does get it. So make sure that if you watch this video, if you haven't registered yet, you run, not walk to thoughtfulmoney.com/conference to buy your ticket there. If you can't watch live the date of the event, which is Saturday, October 18th, don't worry, replay videos of the whole experience. All the presentations, all the live Q&A will be emailed to everybody right after the conference ends. And if you are a premium subscriber to the Thoughtful Money Substack, go read that report from Brent Johnson that I talked about on the AI bubble. But very importantly too, look for the code I sent you that will let you get an additional $50 off of that low early bird price discount for the conference. All right, John, look, my friend, another great week. Thanks so much for coming on and going solo this week, and look forward to seeing you and Mike make sense for whatever happens between now and next week with Mike when we join up again.
Thank you, Adam. Always a pleasure. We got our big Fed meeting next week, so we'll get some kind of fireworks probably. The market is so certain that there's going to be a cut, but out of certainty, sometimes there are some surprises. So we'll watch very closely for that.
Yeah, things, John, they're starting to get interesting. We can argue whether that's good or bad, but it's not dull. And it seems with some of the news we'll have next week, this rocky road's going to keep on rolling.
Absolutely. We'll keep watching, Adam. We'll look forward to chatting next week. And until then, have a great week.
All right, thanks you too, buddy. Everybody else, thanks so much for watching.